That note 3 weeks ago outlined, I think, 4 signs. How would you assess your thesis 3 weeks on?
That's right. After a very extended bear market for MSCI China, we finally believe we may be in the last leg of this extended period. MSCI China has been in the bear market for over 14 months now from the peak that it achieved in February last year, and the index price has corrected by over 50%. That being said, we don't think now is the right time for investors to jump right back into the market and buy the dip. There are still a number of lingering risk factors that we're seeing right now, and we think another 1 to 2 quarters of patience is needed. These risk factors include 2 domestic factors, namely the macro pressure from the Omicron restrictions, and then the property market slowdown, which could cause further spillover effect from the bond market defaults into the equity market. And then there are 2 external factors. One is the global tightening cycle orchestrated by the global central banks, and we have the quantitative tightening cycle kicking off effectively from today. And lastly, the global geopolitical tensions.
Yeah, so Laura, you mentioned a lot of factors there. I have to ask you then, what would it take for you to actually turn bullish on China for the first time in more than a year?
That's right. I think patience is needed. And along these factors, we'd definitely like to see, number one, the market starts to price in more of these earnings downward pressure from the Omicron impact. The consensus is still expecting 15% earnings growth for 2022, and we don't think that's absolutely possible. We are expecting 8% growth only in terms of earnings delivery. And then, of course, the easing measures to kick in and to become more effective for the property market so that the concerns about overall systematic risk could be reduced significantly. And then we'd like to see on the tech front more positive guidance from policymakers for platform economy and more support for the platform economy to grow in a more healthy and proper environment. And of course, a major plus could be an agreement from US and China regarding the ADR dispute agreement, and then the reopening of IPOs for Chinese companies in the offshore market.
Okay, Laura, so on a sector basis then, what do you think has derated enough that things look cheap there, and what do you think has not derated enough in terms of what you're expecting to be, indirectly what you're saying there is we'll still see some downward revisions in earnings?
Yeah, to be very frank, I think the entire market has come down quite a bit. If we look at MSCI China, the valuation has come down from over 18% 12 months forward PE at the peak, down to around only 10 times forward PE right now. That being said, in terms of sectors, we want to look at which sectors can immediately benefit from the easing cycles that's being formed up in the domestic market right now. We know the infrastructure activities are likely to be the first to pick up because of this urgency to lift the overall macro condition. And the policymakers had made it very clear to accelerate the infrastructure activities at the Politburo meeting, which they held at the end of April. So we do like industrials and materials as direct beneficiary from this round of infrastructure activity pickup. And then in terms of sectors, we're still cautious about consumer in general, and then the property sector for obvious reasons, because those sectors are more likely to be under the pressure of macro slowdown. Only after the job market and macro conditions start to stabilize and improve, then we're likely to see the improvement of these sectors.
You also prefer A versus H. Can you talk a bit more about that? Do you think this is a long-term trend? And does that mean that China is encouraging more inflows into their domestic markets and essentially destroying offshore sentiment in a way?
Right. So we have been recommending investors to overweight A shares in their overall China equity portfolio for quite a long time. And since we published our New Year outlook for 2022, CSI 300 actually had outperformed MSCI China by over 15%. And we continue to recommend investors to overweight A shares in their overall portfolio. This is because, again, we are very confident about the easing cycle that's going to pick up and kick in to stabilize the macro condition. And if you look at the past history of different segments of the China equity market, A share market tends to react much more positively following these easing cycles. And even on the long-term trend, we think Asia market is better aligned in terms of thematic opportunities in green economy, in high-end manufacturing, in information technology, and mass market consumption upgrade. So we do prefer Asia's continuously at this moment.
You mentioned long-term. Laura, what do you think is fair value? And let's use one specific index. Let's look at MSCI China because most people look at that. It's about 10, 11 times earnings. Longer term, what multiple do you think this index deserves? And do you think that goes into the other story? Can we still expect high earnings growth from this sector or this index?
For this year, we are expecting 8% earnings growth. That's obviously trying to price in the Omicron impact. And then also, let's not forget the depreciation effect from the currency. For 2023, we actually have a much better outlook in terms of earnings delivery. We're expecting 14% earnings growth for MSCI China. There is the low base effect of this year, but there is the obvious pickup and macro condition stabilization from all the easing measures that's being implemented right now. But we just believe that the transmission mechanism for these easing measures to kick in and be more visibly effective, that's going to take longer time this time around.